Recently, President Trump signed the tax reform bill into law. Today, we will be looking at the new changes and compare it with the current tax law. As mentioned in the disclaimer, I will not be providing legal or tax advice in this video. It is for informational purpose only. If you have a general question, please feel free to comment under the video. If you have a specific tax question, please contact your CPA or tax advisor. So here's a summary of the key provisions in the new law, and let's take a look at the changes one by one. Let's start with the personal tax rates. For 2017, there are 7 different tax brackets with the tax rates of 10, 15, 25, 28, 33, and 35 and 39.6%. How much you will actually owe depends on both your income and your filing status. The new tax law lowers the rates, and the new tax rates are 10, 12, 22, 24, 32, 35, and 37%. Let's move on into the personal long-term capital gains and qualified dividend tax rates, which are taxed at maximum rate of 23.8% currently, and it will remain the same with the rates tied to existing taxable income thresholds. Moving on, maximum pass-through tax rate currently is 39.6%, and the new tax law states that business income that passes through to an individual from a pass-through entity and an income attributable to a sole proprietorship will be taxed at individual tax rates less a deduction of up to 20%. Limited deduction is allowed for income from lower income service businesses, and service businesses excludes engineers and architects. The maximum corporate tax rate has been lowered from 35 to 21%. Personal standard deduction increased substantially, which is a good thing for some taxpayers. This means that the new tax law allows taxpayers to subtract more from their taxable income, which reduces their overall tax bill. But obviously, they can't itemize deductions in this case. So you can either itemize or take the standard deduction. The child tax credit doubled again. This is a good news for families with children, and the new law allows parents to receive a credit of $2,000 per child. And $1,400 is refundable per child. Also, it allows $500 credit for non-child dependents. On the other hand, personal exemption has been repealed by the new law. This was a way to reduce the income tax. There has been a lot of misinformation recently about the personal state, income, sales tax, and property tax, and many rush to pay their property taxes before year end. The new bill clarifies that a payment made in 2017 for year 2018 state for local income tax will be deemed paid on December 31st, 2018, and therefore not deductible in 2017 taxes. A reasonable estimate of a 2017 tax liability, however, may have been paid before December 31st, 2017. And any overpayment credited to 2018 from the 2017 tax year is taxable in 2018 to the extent the overpayment provided a tax benefit. Furthermore, a 2017 overpayment credited to a 2018 state and local income tax liability will be subject to the $10,000 limit for the combined state and local income tax or sales tax instead of income tax, plus real property taxes. Another one is mortgage interest deduction, which is a common itemized deduction that allows homeowners to deduct the interest they pay on any loans used to build, purchase, or make improvements of the residence. And this one was reduced from 1.1 million to 750,000 of debt, including second home. And no home equity interest deduction is allowed by the new tax law. The individual alternative minimum tax, or AMT, is currently imposed when minimum tax exceeds regular income tax. And this was originally designed to prevent wealthy taxpayers from using loopholes to avoid paying taxes. and this one has been modified. The new law increases AMT exemption amounts and phase-outs. There are no changes made to the medical expense deductions. Those remain deductible to the extent they exceed 10% of the adjusted gross income, but keep in mind that it is 7.5% of AGI for years 2017 and 2018. Alimony or spousal support after a divorce was deductible to payor and taxable to recipient in the past. The new tax law provisions state that the payor cannot deduct it and the recipient does not pay taxes on the amount for decrees executed or modified after year 2018. Now, the individual health insurance mandate has been repealed, and this is huge. If you like this one, please feel free to like this video. I'm curious to find out how many people are happy about this specific change. If you have a comment on this topic, I really want to hear it, so please feel free to comment under the video. So really what this is saying is that if you don't have health insurance in year 2019, you basically don't have to pay a penalty. The penalty remains in effect for years 2017 and 18. All right, let's also take a look at a few more business-related changes. Depreciation under current law allows long-term assets to be capitalized and depreciated. In some cases, Section 179 allows immediate expensing of up to $500,000. The new tax law allows immediate expensing of most new and used property, excluding structures, through year 2022, and the Section 179 limit increased to $1 million. Let's move on to the depreciable life of rental buildings, which remains the same and is 39 years for most non-residential buildings, and it's 27.5 years for residential rentals. The net operating loss currently is carried back 2 years and forward 20 years. The new tax law repeals carryback net operating loss, except for the farms, which is 2 years, and allows indefinite carryover deduction, but limited to 80% of pre-net operating loss income for losses generated after year 2017. On the other hand, there was no provision regarding the excess business losses in the past. The new law states that the net business loss in excess of $500,000 or $250K for single are not deductible. They become a net operating loss carried over to the next year. The business interest has been generally deductible in the past. The new tax law states that the business interest is generally limited to the extent that interest exceeds 30% of income and allows unlimited carryover of excess. It is determined at entity level by its spillover effects to the owner, and limitation is not applicable if average annual gross receipts do not exceed $25 million. Okay, so moving on to the cash method of accounting. Currently, this method is generally limited to businesses with less than 1, 5, or 10 million in receipts, depending on facts. The new provision expanded to include businesses with less than 25 million in receipts, with special rules for tracking inventory cost. Domestic production activities deduction. Currently, the law allows domestic producers to get a deduction equal to 9% of their qualifying income. This provision has been repealed after year 2017. And the last one for today is gift and estate taxes. Currently, there is a tax of up to 40% imposed on gifts and estates, subject to a 5.49 million lifetime exemption per spouse. The new tax law doubles the lifetime exemption. Estate tax remains in effect and step up in basis is retained. Obviously, this is not a complete list of all the changes. I've outlined the ones that stand out the most. And as always, thank you for watching our videos. We always welcome comments, likes, and shares. In fact, we love it. So feel free to like, share, comment, and subscribe to our channel, Let's Talk Money, if you haven't done so yet. And again, thank you for watching.